The Rebel Capitalist Show.
I was actually on Chris Cole's website. I've been doing a lot of reading. He's got a new paper. Everyone's very familiar with the dragon portfolio and the allegory of the hawk and serpent. But he actually came out with another paper called The Rise of the Dragon, where he actually does back testing with the dragon portfolio for 2020 and compares how it did relative to like a risk parity portfolio, the 60-40 portfolio that most people know about through their financial advisor. And it's just staggering how well the dragon portfolio did. I think it was up like 52% or something like that. He's got the numbers in this most recent report. But anyway, that was kind of right on my mind. So we were talking the other day and you said, well, maybe let's do a video for some people who might be new to options, or maybe some people that have a little bit of experience on how they could kind of build this into their own portfolio, this concept of the dragon portfolio, while at the same time maybe giving them some information as to how they could use options to also create cash flow, which is something that I'm always interested in, being a real estate guy. So that's why we've got you here today. So I'll just hand it over to you so you can teach us how to work the dragon portfolio that did so well in 2020 and make a little bit of cash flow from these options.
Sounds like a plan. So what I want to talk about is, so last time when we were together, we were talking about how to go long volatility with options. There's all sorts of ways to build that volatility component of your portfolio, give you tail risk insurance on all sorts of volatile moves that can occur in there. And of course, we did that presentation and we had a great time with it. But one of my favorite strategies, one of the most consistent strategies that I utilize is options as an income source. And to me, this is such an important and valuable strategy for people to know that exists and how to utilize it. And what I love about options as an income source, whether through covered call writing, selling puts, or doing any of these types of things, it diversifies you from where your returns are coming from. And one of the great things about a dragon portfolio or something like this is that, you know, by owning all the different asset classes, you're supposed to create these uncorrelated things that are moving and creating that long-term return. But what happens is when you own the equity components of your portfolio, a lot of times you're going to see that you need the capital appreciation of those equities to make your return, and you need and they tend to all go together. In other words, you if there's a bull market phase and you have a great 3 months, you'll see the majority, like a tide rising in the water, like your portfolio goes up because all of those things are moving with the market. But what's always interesting is how do you create a return in a period when the market isn't so bullish, when things are more flat, sideways? How do you create something that performs when other things aren't? And I view option writing and the premium, what I call premium harvesting, as a diversifier, because it's a not correlated to market movement. You don't need the market going up or down in order to make this return. So let's actually go through that thought process here, George.
And one thing I want to point out, that our good friend Lynn Alden actually uses this strategy herself, because I know a lot of my viewers and listeners are big fans of Lynn, as I am, and just FYI, she uses this to a certain degree in her own portfolio.
And you know, this beautiful thing is that there are so many different ways to apply the strategy, George. And you know, Lynn might have one way and I have another way, but the key is one has to simply educate themselves to know that this is even a choice. There's so many people out there that don't even know that they could do this, or even if they could, how to do it consistently, how to make this a part of your portfolio. And so what I want to basically ask the question over here is, when you buy traditional investment, let's say you just buy an ETF or some market index or something like that, how much return are you going to make, and how long is it going to take you to make that return? There's a lot of questions that, you know, you buying it and you hope that the investment will go up and that it will work, but in the end, there's a lot of uncertainties. What I love about options writing or premium harvesting is that when we sell an option premium to earn a return, we know exactly how much cash flow we're going to make, and we know how long it's going to take for us to make it. And so so we can turn around, and if I collected 10% over 3 months in one income right, then I know it's going to take me exactly 3 months to make 10% in cash flow. And cash flow is not total return because the stocks are fluctuating higher or lower and things like that. But the premium that we harvested is a fixed amount. It's as real as a dividend. So when you sell a premium and that cash is literally deposited into your account right away, and you literally see your cash balance increase. Let's say we're using that 10% number I was saying. When I sell that premium, and collect 10% on that, it will literally increase your cash balance in your account. And whether the stock fluctuates higher or lower, that 10% is yours to keep.
Right.
And when we sell that option, let's say for 3 months, we know it's going to we have entered an obligation for 3 months of time in order to earn that 10%.
Yeah.
And so it creates a fixed element to that.
Yeah, Patrick, let me interject a couple things here. First and foremost, I want to make sure that if people feel as though this is a little over their head, or what you're saying right now is kind of intimidating, just bear with us, because it's something that even a beginner can do if they're willing to put forth a little time. I'm not saying you just dive in head first, but as far as you don't need to be a rocket scientist to figure this out. It's pretty straightforward once you learn the lingo. I want to point that out. Then also, a lot of people that watch my videos know I prefer something I call a 10-80-10 portfolio, which is 10% insurance, 80% investing. But I define those investments as things that pay you to own them. So I haven't even thought about it, but I don't know, maybe this might fit into that category, because it definitely pays you to own it. What I'm going to be really curious to find out throughout the rest of the interview here is if you can do this, if you can use this strategy over the long term, like as an example, not have to roll it over every 3 months, but do one trade where it's for the next 2 years or something.
You totally
like
can.
That.
You
Yeah,
totally
okay.
can.
Cool.
And because there are long-term options on that.
Yeah.
And the now just circling back to have that conversation about how it fits into a portfolio. The beautiful thing about the strategy we're covering, while it is most common for us to demonstrate it on stocks. So we're going to pick an equity. We're going to pick some sort of a stock and demonstrate the option rating. This strategy is readily available. You can option write on gold bullion. You can option write on bonds, like treasury bonds. You could option write on Bitcoin. You can. This is not about just an equity asset class. You can use this income strategy for any one of the asset classes within your mix.
Yeah, Patrick, correct me if I'm wrong, but basically what we're doing with this strategy is you're just turning yourself into an insurance provider.
Something
Right?
like that.
You're just kind of selling a premium. They're giving you these premium payments. Is that?
Absolutely. I call it the stock rental business. And so what we're doing here is rather than playing a stock from its appreciation, saying like, I want all of the upside of the stock, what you literally can do is rent out your shares to a speculator and be paid a guaranteed income up front for giving them the upside of the market, and you taking a certain guaranteed income up front. But the one thing I wanted to point out on this chart over here, George, is that when we buy just a traditional investment, you actually have to be somewhat right about its direction to be profitable. In other words, you have to buy it and it has to go up for you to make money. So when you own that investment, even if it's paying you a modest dividend, you've lost the opportunity to make meaningful gains. Let's say if over the next year that investment is just stuck in the mud. And so therefore, in order to be good at investing, everyone is channeling all of their emotional energy into what is hot, what is moving, where is the money being made, because I got to own the stuff that's working. But the beautiful part about option writing is that we, in order to be profitable, just actually have to pick stocks that are going to stay even flat. And they could appreciate. But the benefit of this is the fact that we don't have to be good stock pickers. We just can't be really bad ones. In other words, in, in other words, you have to create a scenario where you just can't be buying the shit, right? Like the stuff
Right.
that could wipe out 50% on the downside. You want to pick stocks that are going to be somewhat stable. And even if they're not going up, you're able to generate a cash flow off of them. And so becomes a very forgiving strategy, because you don't have to always be chasing that one hot thing that could be the hot thing in the market. You're just being a cash flow pig. You're just basically sitting there continuously grabbing at income, bringing it in.